Welcome to an introduction to macroeconomics, brought to you by David Hopcroft from Parkbench Tutors. This short podcast will introduce you to macroeconomics. To find out more about the tutorial work we offer, please visit parkbenchtutors.com. Perhaps the easiest way to begin to understand macroeconomics is just to say that it deals with the economy as a whole. What do we mean by this? We mean that it looks at issues such as unemployment, inflation, balance of payments, and distribution of wealth. We talk in terms of aggregates. So to understand these issues, we need to know what we mean by an aggregate. An aggregate means a sum, or a total. So we are considering total output for goods and services, total demand, total employment, and so on. So aggregates are made up of their individual parts. Let us consider just one of these aggregates. The aggregate demand will be the sum of all the individual demands. We can state this by saying that the aggregate demand will equal the sum of all the individual demands for goods and services. The sum of individual firm demands for investment goods, government demands for goods and services, foreign demand for export, and home demand for imports. We shall express this as AD equals C plus I plus G plus X minus M. The immediate problem we face is how to measure. What are the units that we need to use? If we are considering tons of wheat, meters of cloth, pairs of shoes, and compact discs, then we need to find something in common. They can all be given a value in terms of money. This is not as easy as it sounds. The price of goods varies over time with features such as inflation. To compare values over time, we need a scale of reference. In the United Kingdom, the scale for reference is either the Retail Price Index or the Consumer Price Index. Total output in current prices is then converted to total output in constant prices. Price indexes are not perfect. We cannot average every single good that is produced, so we make use of the idea of weighted averages by using the prices of a number of selected goods. We also need to be cautious in making assumptions, since if the output is received by only one group, we should not immediately jump to a conclusion that economic welfare is rising. It may help you understand what is being measured by looking at a flow model. The model represents a flow of income and spending. The major players are households and firms. Households provide a service to firms when they are employed and receive an income, which is then largely spent on consumption of goods and services. Part of the output from firms goes to foreign trade. Part of the household consumption will be foreign imports. Firms and households both pay taxes to the government and in return may receive benefits from government spending. The diagram is really quite simple. Let's see if we can clarify a few terms and relationships before we go any further. What do we mean by consumption? Consumption is the total expenditure by households on all the goods and services which yield utility in the current period. Note that we have to state a period of time. Remember that we came across the concept of utility in our study of microeconomics. Remember that utility was considered to be the benefit that we derive from goods and services. Most of us do not consume or spend every cent that we receive. Some may go to savings. Savings are that part of disposable income not spent in the current period. Note again that we have to give a period of time here. What do we mean by disposable income? It is that part of income after we have paid taxes. Remember that taxes does not refer only to income tax. Other government deductions are in effect taxes if they come from total income. If we subtract the amount that we save from this disposable income, then, in theory, we should have a figure for consumption. Firms do not have savings, but they do invest in goods or services that are not for current consumption. We can return to the idea of total output. There are three ways we can measure this. We can measure the national product, the national expenditure, or the national income. What do we mean by these terms? Consider first the national product, which is the value of all goods and services produced during the year. So, if we sell some wool and make a sweater, then sell the sweater, are we double counting? If you are familiar with the way that value-added taxation works, then you will understand the idea of the sum of value added. If we added up all the sales here, then we should end up with 50 plus 80 plus 100 plus 120 plus 200, which gives $550. This, however, has fallen into the trap of quadruple counting. So to avoid this, we consider only the value added at each point, and then take the sum of these values. When the iron ore is first sold, the initial value added is $50. When the steel maker sells on to the rolling mill for $80, then the value added equals 80 minus 50, which is $30. When the rolling mill sells on to the roofing contractor, the value added is 100 minus 80, which equals $20. So by doing this at each stage, the total value added is equal to $200. Note that this is also equal to the final cost. Now consider national expenditure, which is the spending on all goods and services produced by firms. In this case, expenditure is by domestic consumers, by the government, and by means of exports. As it stands, this would not be equal to national product because there will be unsold goods. To be equal to national product, you would need to add in the value of the unsold goods. As with national product, there is a need to avoid double counting. Only spending on final goods and services should be included. National income is the aggregate of all income of all factors of production. So here we should include wages, salaries, interest, rent, and profits. So all three of these are measures of national output, so they should be equivalent to each other. They are simply different ways of measuring output over a period of time. It all sounds a little too simple, and in reality there are other things to consider. There is a difference between gross product and net product, gross expenditure and net expenditure, and gross national income and net national income. One thing that is missing is consideration for depreciation, which is how accountants allocate the cost of using or expensing equipment over time. Some investment over the year is being used to replace capital used or depreciated. To go from the gross figure to the net figure, we simply subtract the value of depreciation. In practice, economists will work with gross figures, since the depreciation change is slow and the figures very difficult to even estimate. Another consideration is how to treat the value of unsold goods. If prices rise during the year, then the value of the unsold goods rises as well, and should be valued accordingly. And note that in the United Kingdom we refer to unsold goods as stock, whilst in the US the more appropriate term would be inventory. You might note that where we use the term shares in the UK, the US would use the term stock. National expenditure can be distorted. Take alcoholic drinks as an example. In the United Kingdom these are heavily taxed, and the expenditure at a market price should really exclude this taxation. In the case of a subsidy, it should add that figure. So, by subtracting taxes and adding in subsidies, we get national expenditure at factor cost, which is the preferred measure for economists. How do we take into account any production from firms that are owned by overseas companies? What about a firm overseas that is owned from within the UK? The convention here is to take the domestic product and add any property income from abroad to get the national product. The same argument would apply to obtain national income from domestic income and to obtain national expenditure from domestic expenditure. Even with all these adjustments, our figures are never going to be entirely accurate, and we call the differences due to residual error. One feature here to note is that gross national expenditure usually exceeds gross national income. The difference, in part, is due to what is referred to as the black economy. This essentially describes illegal activity designed to avoid payment of taxes. Estimates of the error due to this vary from around 3% to 8%. What counts as black market activity is not always clear. If I service my neighbour's automobile and accept cash, then most would argue that I am avoiding taxation. However, what about when I service my own automobile? These are surely not earnings. Then, what if I service my neighbour's automobile whilst he paints my kitchen? So, if national income is rising from year to year, does this automatically mean that economic welfare is also rising? To make statements about economic welfare, we first have to convert the figure for national income to real national income, and then to restate it as national income per capita. These two steps are very important in economics. The first step takes us back to the idea of a price index. We restate national income by reference to the price index. This will nearly always mean that we are deflating the figure for national income. To adjust to a per capita basis, we need to reference it to the size of the population, so we must also take into consideration any changes in population. Here is a sample set of figures. National income has apparently risen by $10 million, but the price index has risen from 100 to 140. The population has also risen by 400 persons. Using the price index, I will adjust by multiplying the national income by the result of 100 divided by 140. I get a figure of $20 million. Now I divide this figure of $20 million by the current population to get a figure of $3,215. I can now complete my table, filling in the values for real national income, which I calculated as $20 million, and for real output per capita, which I calculated as $3,215. Now, has there been a change in economic welfare? Well, for there to be actual improvements, economists would argue that at least one individual must be better off without anyone else becoming worse off. This is the Pareto condition. Again, this is an idea that we met earlier in microeconomics. An easier understanding is to look at potential improvement and say that if the amount of improvement for the better off more than compensates for those who are less well off, then there has been potential improvement. Sociologists might question this idea, since the gap between rich and poor could widen considerably and there could still be potential improvement by this idea. Anyway, the idea is known as the Hicks-Kaldor condition. Pseudo-improvement takes place if other factors are not being considered. Output may well increase, but so may pollution, or the number of hours being worked. A similar problem occurs for accountants when trying to determine costs, and the concept of environmental accounting is now becoming more significant. Can we apply these ideas across international borders? The answer is a guarded yes. We need to make some adjustments. The correct rate of exchange must be used. There are still difficulties though, since different nations have different needs and preferences. Governments are always interested in the results of economic activity. Most governments will try and produce policies that aim to bring down unemployment, reduce inflation, and produce economic growth. Aggregate or total demand may not be the same as national expenditure, since the aggregate is taken to be the figure for planned expenditure. So we use the idea of actual expenditure to mean national expenditure, and for planned expenditure to mean aggregate demand. In microeconomics, we introduced the idea of equilibrium as being when the demand for a good was equal to the supply of that good. We can use a similar idea in macroeconomics, where we say that for equilibrium level of national income, the aggregate demand must be equal to aggregate supply. This ends our first podcast on macroeconomics, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and listening. We wish you every success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.